Something is quietly changing in the financial world, and most people don't even realize it yet. On the surface, everything looks normal. People go to work, earn money, and continue with their daily routines. But beneath that routine, the global financial system is constantly shifting. History shows that when these shifts happen, they rarely affect everyone the same way. Some people are caught completely off guard, while others are prepared and able to protect their money. In many cases, the people who understand what's happening early are the ones who come out stronger. And right now, there are signs that another important financial shift may already be beginning. Over the past few years, many people have started noticing small changes in the financial world. At first, these changes may not seem dramatic, but when you step back and look at the bigger picture, they begin to reveal a pattern that is worth paying attention to. One of the first warning signs many people notice is rising debt. Governments, companies, and even households are carrying more debt than ever before. Borrowing money has become extremely common in modern economies. Governments borrow to fund programs and infrastructure. Businesses borrow to expand operations. Individuals borrow for homes, cars, education, and everyday expenses. Debt itself is not always a bad thing. In many cases, it can help fuel growth and opportunity. But when debt grows too quickly across an entire system, it can create pressure that becomes difficult to manage over time. Another sign people have been noticing is inflation. Inflation simply means that the price of goods and services rises over time. Many people feel this directly in their daily lives. Groceries cost more than they used to. Housing prices have increased in many areas. Even everyday items like transportation, insurance, and utilities can feel more expensive than they did just a few years ago. Inflation is a natural part of most economies, but when prices rise faster than incomes, people begin to feel the strain. Savings lose purchasing power, and money does not stretch as far as it once did. Alongside inflation, there have also been changes in currencies and financial systems around the world. Many governments are exploring new forms of digital currency and modern payment systems. Technology is changing the way money moves between people, businesses, and institutions. Some countries are experimenting with digital versions of their national currencies, while others are updating financial regulations to adapt to new technologies. These changes do not necessarily mean something negative is happening, but they do show that the global financial system is evolving. Another factor worth understanding is economic cycles. Economies rarely move in a straight line forever. Throughout history, economies have gone through cycles of growth, slowdown, correction, and recovery. These cycles are a normal part of how markets function. During periods of growth, businesses expand, employment increases, and financial markets often perform well. But eventually, economies tend to slow down, adjustments happen, and the cycle begins again. This pattern has repeated itself many times throughout history. For many people, these changes may feel distant or difficult to understand. But the important thing to remember is that financial systems are always evolving. The goal is not to panic or fear change. Instead, it is to understand the broader environment and become more aware of how economic shifts can affect personal finances. When people begin paying attention to these patterns, they start to see that money is not just something we earn and spend. It is also part of a larger system that moves through cycles over time. And those who understand these cycles are often better prepared to adapt and make smarter financial decisions. When people hear the phrase money reset, it can sound dramatic or confusing. But in reality, financial resets are not something new. Throughout history, economies have gone through periods where adjustments happen, and the financial system slowly changes in response. These changes don't usually happen overnight. Instead, they develop gradually through different economic forces that shape how money behaves over time. One common example is inflation cycles. Inflation occurs when the general price of goods and services rises over time. A small amount of inflation is normal in most economies, but when inflation becomes stronger, it changes how money works in everyday life. For example, the same amount of money that once bought many things may start buying less. People begin to notice that prices are higher, while the value of money feels lower. When inflation becomes significant, governments and financial institutions often make adjustments to stabilize the economy. These adjustments can include changes in interest rates, monetary policies, or other economic measures designed to slow inflation and restore balance. Another type of financial adjustment involves currency changes. Currencies are not fixed forever. Over long periods of time, countries may modify how their currency works or introduce new systems that improve how money moves through the economy. Historically, some countries have replaced older forms of currency, restructured financial systems, or introduced new technologies that modernize how payments and banking operate. Today, many people are seeing early signs of this kind of evolution through digital payment systems and financial technologies that are transforming how money is stored, transferred, and used around the world. A third factor that contributes to financial resets is economic correction cycles. Markets and economies tend to move in cycles. Periods of growth are often followed by periods of adjustment. During strong economic growth, businesses expand, investments increase, and financial markets may rise. But eventually, markets correct themselves. Prices adjust, debts are reorganized, and the economy moves into a new phase of balance. These corrections are not necessarily negative. In many cases, they are simply part of how economic systems maintain stability over time. Understanding these patterns helps people see that financial resets are not mysterious events. They are part of the natural evolution of economic systems. When inflation cycles shift, when currencies adapt to new technologies, and when markets move through corrections, the financial landscape slowly changes. For individuals, the most important lesson is awareness. People who understand how these cycles work are often better prepared to adapt. They recognize that money is not static. It moves within a system that evolves as economies grow, technologies advance, and societies change. And those who pay attention to these patterns are often in a stronger position to protect. When financial uncertainty begins to appear, many people react in ways that actually make their situation worse. These reactions are very common, and they usually come from fear, confusion, or a lack of financial understanding. One of the biggest mistakes people make is panic selling. When markets become unstable or when negative financial news appears, many people rush to sell their investments as quickly as possible. They see prices dropping or hear warnings about economic trouble, and their first instinct is to get out before things get worse. The problem with panic selling is that it usually happens at the worst possible time. Financial markets have always moved in cycles. Prices go up and prices go down. Corrections and downturns are normal parts of how markets function. But when people panic, they often sell after prices have already fallen. In other words, they lock in their losses. Later, when markets eventually recover, those same people may hesitate to return because they are afraid of losing money again. As a result, they miss the recovery that often follows economic downturns. Throughout history, many of the people who built wealth during uncertain times were not the ones who reacted emotionally. Instead, they stayed calm, stayed informed, and focused on long-term strategies rather than short-term fear. Another common mistake is ignoring finances completely. When financial topics feel confusing or stressful, many people avoid thinking about them altogether. They may stop checking their bank accounts, delay reviewing their expenses, or avoid learning about how money works. This avoidance can feel comfortable in the short term, but it creates problems over time. Ignoring finances is similar to ignoring a small leak in a house. At first, it may not seem serious, but if it is left unchecked, the damage slowly grows. For example, debt can slowly grow through interest. Spending habits can quietly reduce savings. Missed opportunities to invest or prepare financially can accumulate over the years. People who ignore their finances often find themselves reacting too late, when the situation has already become difficult to manage. A third mistake many people make is spending too much during stable times. When the economy feels strong and income is steady, it is easy to believe that the good times will continue indefinitely. People may upgrade their lifestyle, purchase more expensive items, or increase their spending habits. New cars, luxury items, expensive vacations, and other purchases can feel rewarding in the moment. But when spending grows faster than financial stability, it creates vulnerability. If an economic slowdown occurs, people who have built a lifestyle around constant spending often struggle the most. They may have high monthly expenses but very little savings, or financial flexibility. This is why financial stability is often built during good times, not during difficult ones. The final mistake many people make is not preparing at all. Preparation does not mean predicting the future perfectly. No one can know exactly what the economy will do next. But preparation means building habits that make financial challenges easier to handle. For example, having savings available during unexpected events can reduce stress and provide options. Understanding how debt works can help people avoid financial traps. Learning about investing can allow money to grow instead of sitting idle. Unfortunately, many people only begin thinking about preparation after a financial problem has already occurred. They wait until a crisis forces them to act, but by that time, the options available may be limited. Financial awareness works best when it begins early. The people who prepare during calm periods are often the ones who feel more confident during uncertain times. This doesn't require extreme actions or complicated strategies. It simply requires paying attention, building healthy financial habits, and staying informed about how money works. When people avoid panic, stay aware of their finances, control their spending, and prepare gradually, they place themselves in a much stronger position to navigate economic changes. And while no one can eliminate financial uncertainty completely, those who approach money with awareness and discipline often find themselves far better prepared. While many people react to financial uncertainty with fear or confusion, others take a different approach. Instead of trying to predict every economic change, they focus on building habits that make their financial situation stronger over time. The first thing many financially aware people focus on is controlling debt. Debt can be useful when it is managed carefully, but too much debt can limit financial freedom. High-interest debt, especially from credit cards or short-term loans, can slowly drain a person's income without them fully realizing it. Smart financial habits often begin by reducing unnecessary debt and avoiding borrowing for things that quickly lose value. When people reduce the amount of money they owe, they create more space in their budget and gain greater control over their finances. Instead of constantly paying interest to lenders, they can begin directing more of their income towards saving, investing, or building long-term security. The next habit financially prepared people build is saving consistently. Savings act as a financial safety net. Unexpected events can happen at any time: job changes, medical expenses, or sudden repairs. When people have savings available, these situations become much easier to manage. Saving money does not always require large amounts. In many cases, small but consistent contributions can slowly build a meaningful financial cushion. Setting aside a portion of income each month, even if it starts small, can gradually create stability. Over time, this habit becomes one of the most important foundations of financial security. Another key behavior is investing wisely. Many people assume investing requires complicated strategies or large sums of money, but in reality, investing often works best when it is simple and consistent. Instead of chasing quick profits or risky opportunities, financially disciplined individuals often focus on long-term growth. They look for ways to allow their money to grow gradually through investments that align with their goals and time horizon. This approach may not create overnight wealth, but over many years, it can allow money to compound and grow steadily. One of the biggest advantages of investing wisely is that it allows money to begin working independently. Instead of relying only on income from work, investments can slowly generate additional growth over time. The final habit that sets financially aware individuals apart is continuing to learn about money. Financial knowledge is one of the most powerful tools a person can develop. The more someone understands how money works, the more confident they become when making decisions. Learning about budgeting, investing, debt management, and financial planning allows people to recognize opportunities and avoid common mistakes. Today, financial education is more accessible than ever. Books, podcasts, educational videos, and online resources provide valuable insights that can help people improve their financial understanding. What matters most is the willingness to stay curious and continue learning. Financially prepared people rarely assume they know everything. Instead, they keep expanding their knowledge so they can adapt to changes in the economy and make smarter choices over time. When you look at these habits together, controlling debt, building savings, investing carefully, and learning about money, they form a strong foundation for long-term financial stability. None of these actions require perfect timing or special insider knowledge. They are simply practical steps that anyone can begin taking regardless of their starting point. By focusing on these habits, people place themselves in a stronger position to navigate. When people hear about economic change or financial uncertainty, the first reaction is often fear. Many people immediately think about risk, loss, and instability, but history shows something very important. Major economic shifts do not affect everyone in the same way. Every economic transition has always created two groups of people. The first group is made up of people who are caught completely off guard. They continue with the same habits, ignore the changing environment, and only react once the situation has already become difficult. The second group is made up of people who pay attention, prepare gradually, and adjust their financial habits early. Throughout history, these two groups often experience very different outcomes. Periods of economic change have always produced challenges, but they have also created opportunities. For example, after major financial downturns, new industries often emerge. Technologies develop, businesses adapt, and entire markets begin to grow in new directions. People who remain informed and prepared are often able to recognize these opportunities earlier than others. One important lesson from history is that economic shifts do not simply destroy wealth. In many cases, they redistribute it. When systems change, the way money flows through the economy also changes. Certain industries may slow down while others expand. New opportunities appear in places that were not obvious before. Those who understand these patterns are often better positioned to take advantage of them. This does not require predicting the future perfectly. In fact, trying to predict every detail of the economy can be extremely difficult. Instead, preparation often comes down to building strong financial habits. People who manage debt carefully, maintain savings, and continue learning about financial systems tend to adapt more easily when economic conditions change. Rather than reacting emotionally, they are able to make thoughtful decisions based on information and preparation. Another important advantage comes from perspective. When someone understands that economic cycles are a natural part of history, uncertainty becomes less intimidating. Instead of viewing change as a threat, they begin to see it as a period of adjustment that may also create new possibilities. Throughout many economic shifts, individuals who remained patient and disciplined were able to build wealth while others focused only on short-term fear. This does not mean that change is easy or predictable, but it does mean that awareness and preparation can make a significant difference. In many ways, financial opportunity often appears during moments when others feel uncertain. By staying informed, maintaining strong habits, and continuing to learn about how money works, people place themselves in a better position to navigate change. And while no one can control the global economy, individuals can always control how they prepare for the future. History has shown again and again that economic shifts create challenges, but they also create opportunities for those. In the end, financial awareness is one of the most powerful tools anyone can develop. The world of money is constantly evolving, and those who take the time to understand it place themselves in a much stronger position for the future. You don't need to predict every economic change or make perfect decisions. What matters most is starting to pay attention and taking small steps in the right direction. Learning about money, building better habits, and staying informed can slowly transform your financial future over time. Small actions today can lead to big changes tomorrow. If you found this video helpful, make sure to subscribe to the channel for more videos about money, financial awareness, and building long-term wealth. And if you want to understand one of the biggest financial traps people fall into, watch the video on your screen now. Why hardworking people stay stuck in the debt trap.